Welcome to the deep dive. Today we're really digging into the latest results and maybe more importantly the pretty bold strategic plans coming out of Leela Palaces Hotels and Resorts limited to LPHRL.
That's right. We're looking at their Q2 fiscal 26 earnings presentation and the call transcript, both from October 14th, 2025. And it's worth remembering, LPHRL is India's only listed pure-play luxury hospitality brand.
Which makes their moves kind of a bellwether, doesn't it?
Exactly. What they do often signals trends for the whole luxury segment in India.
Okay, so our mission today, yes, we'll touch on the key numbers, but we really want to break down the big strategic plays. We're talking their first international move into Dubai and a really interesting shift in a key domestic project in Mumbai.
Right. The goal is to understand how these moves fit together, how they're funding them, and how it all points towards that, well, frankly, ambitious long-term target they've set.
Which is?
Getting to 20,000 million in EBITDA by fiscal 30. That's a huge number.
It is. So the big takeaway seems to be this wasn't just a quarter about numbers ticking up. It was about decisive strategic action.
Absolutely. Disciplined execution is the theme that keeps coming up in the materials.
Okay, so let's start with the foundation. You can't make big global moves without a strong home base. How did Q2 fiscal 26 look financially? What were the headline figures?
The domestic performance was very strong. Consolidated total revenue up 11% year-on-year, hitting 3,334 million.
Okay, solid growth and profitability.
Even better, actually.
Mhm.
EBITDA grew faster, up 17% year-on-year to 1,647 million. And significantly, this was their fourth straight quarter of positive profit after tax. PAT came in at 747 million.
4 quarters of profit. That signals real stability. But for luxury hotels, the real post-check is often RevPR, right?
Oh.
Revenue per available room. What happened there?
RevPR was definitely the operational highlight. For Q2, it jumped 13% to 13,262.
13%. How did they achieve that? Was it just filling more rooms or pricing power?
It was balanced, which is what you want to see. The average daily rate, or ADR, was up a healthy 7%, reaching 19,290, and they also increased occupancy by full percentage points, hitting 69%.
So charging more and filling more rooms, that's strong.
It really is. And when you put that 13% RevPR growth in context, well, it's quite remarkable.
How so? Compared to the market.
Exactly. The source material points this out quite clearly. In the first half of fiscal 26, LPHRL's RevPR growth was 3 times the growth rate of the Indian luxury segment benchmark.
Wait, 3 times. So if the average luxury competitor saw, say, 4% growth, Leela hit 13%.
That's the picture, yes. They're not just growing with the market, they're actively taking share. It's quite aggressive outperformance.
And that kind of operational strength must be flowing through to the bottom line, right? Margins.
Absolutely. EBITDA margins hit 48.2% in Q2, which is very healthy. And if you look at the first half of the year, the operating leverage was impressive. About 77% of every extra rupee of revenue converted straight into EBITDA.
Wow, 77% flow through. That shows tight cost control alongside the revenue gains.
It really does. Discipline is the word.
Okay, so they've clearly got the domestic engine firing on all cylinders.
Yeah.
That 3x market growth proves it. Now let's talk about where they're taking that strength. Dubai. This is the big one, isn't it? Their first international step.
It's like a major move. They've signed binding agreements for a stake in an existing operating luxury beachfront resort. And the location is prime, right on Dubai's Palm Jumeirah.
The Palm, that's iconic territory, near the Atlantis, the Royal, I believe.
That's the one, right next door. And it's a substantial property, 23 acres, 546 keys in total. That breaks down into 361 hotel keys, plus 182 branded residences and 3 villas.
So not a small entry. How is the deal structured? Are they going it alone?
No, and this is crucial. They're leveraging their relationship with Brookfield, their sponsor. LPHRL is taking a 25% equity stake.
Okay, and Brookfield.
Private funds managed by Brookfield are acquiring the other 75%. This partnership is really key. It gives LPHRL access to these huge trophy assets without needing to front all the capital themselves. Brookfield brings the financial muscle and the global network.
Makes sense. So what's the capital outlay for LPHRL's 25%? And you mentioned something about an innovative structure.
Right. The upfront capital for LPHRL is around $49 million, which is about 4,370 million. But here's where it gets really interesting, what they're calling the equity recycling mechanism.
Equity recycling. Okay, break that down. Sounds potentially very efficient.
It really is. The core idea relies on those 182 branded residences that are part of the property.
The ones they're selling.
Exactly. LPHRL expects to sell these residences and use the proceeds to effectively recoup 100% of their initial $49 million equity investment.
Hold on. Are you saying they could end up owning 25% of a luxury hotel on the Palm Jumeirah for basically zero net capital investment?
That's the goal, yes. They anticipate getting all that equity back within about 2 to 3 years from the residence sales. It's smart financial engineering.
Assuming the Dubai-branded residence market holds up, of course.
That's the key assumption, yes. But if it works...
If it works, what's the ongoing value besides just owning the stake?
Well, after the equity is recycled, they'll still hold that 25% stake essentially for free from a net equity perspective. Plus, they'll be earning annual hotel management agreement fees, HMA fees for running the hotel under the Leela brand.
And what kind of fees are we talking about?
They're projecting those fees to stabilize somewhere between $55 million and $65 million per year. And the entry valuation seems attractive too. The purchase price works out to about 12.8 times the estimated calendar year 2025 EBITDA. For an asset like this, that's a good multiple.
So potentially zero net cost ownership plus ongoing management fees. That is a very clever way to go international.
It really shows that focus on capital efficiency. And we see that same thinking playing out domestically too, especially with the big project in Mumbai's Bandra Kurla complex, BKC.
Right, BKC. There was a significant change in the plan there, wasn't there? A restructuring. Why did they revise the approach for such a prime location?
It's another example of them focusing their capital where they believe they can get the best returns, sticking to their core competency, essentially.
Which is luxury hotels, not office blocks.
Precisely. The original plan was for a mixed-use development, a Leela Palace hotel, plus about 0.7 million square feet of Grade A office space, jointly owned.
Okay.
But under the revised structure, LPHRL is stepping back from the office component. They're going to retain and fund a 50% stake only in the hotel part, which will have 250-plus keys.
And the office space, who takes that on?
Brookfield. They will now fully own and fund the entire 0.7 million square feet of office space.
Interesting. So LPHRL sheds the capital burden and complexity of the office tower. Why? Is the return profile that different?
That seems to be the calculation. LPHRL's capital contribution is now focused just on the hotel, around 800 crores spread over 4 years, and they're projecting a stabilized yield on cost of about 16% for that hotel investment.
16%. That's a strong target yield for a hotel.
It is, and likely higher than what they'd expect from the office component, which typically has lower yields, although arguably more stable income. So they're optimizing for higher returns on their deployed capital by sticking to the high-margin hotel business.
Makes strategic sense. Focus the firepower.
Yeah.
And it's not just about new builds. They're also squeezing more value out of existing assets, right? Creating this luxury ecosystem.
Yes, absolutely. They rolled out several initiatives in Q2 aimed at increasing the average spend per guest within their properties. First, there's the launch of the ARQ Club.
The members club.
Right, ultra-exclusive, invite-only. It's now up and running at the Leela Palace, Bengaluru, and they plan to launch in New Delhi and Chennai later this fiscal year. Creates stickiness and another revenue stream.
Keeps the high-value guests within their walls. What else?
Second, the retail repositioning at Leela Palace, Bengaluru seems quite significant. They've basically relaunched about 34,000 square feet of luxury retail space.
Bringing in big names.
Yes, anchor tenants like Sabyasachi and Zoya. The expectation is that this revamped retail wing will generate over $100 million in new revenue annually.
Turning potentially underused space into a prime shopping destination. Smart.
Definitely maximizing the real estate. And third, F&B food and beverage continues to be a focus. They reopened the well-known Franco-Italian restaurant Le Cirque at the Leela Palace, New Delhi.
Oh, Le Cirque is back. Where did they put it?
Interestingly, they repurposed a former business center space for it. Shows they're willing to adapt spaces for higher value use. And this focus on unique F&B pays off their bar. ZLB23, for instance, was recently ranked among Asia's 50 best bars.
So it's becoming more than just a hotel stay. It's dining, shopping, exclusive clubs.
Exactly, a whole luxury experience loop. And it seems customers appreciate it. Their Net Promoter Score, or NPS, was a very high 86 for the first half of the year. That reflects strong customer loyalty.
Okay, so they're making these big moves in Dubai, restructuring in Mumbai, enhancing existing assets. All of this requires a solid financial base. How does the balance sheet look after the IPO and with these new commitments?
The financial position looks very strong, actually. That IPO clearly helped. Their net debt to last 12 months EBITDA is down to a very comfortable 0.5x.
Yeah, 5x. That's very low. Gives them a lot of headroom.
It does. And they've also managed their debt profile quite effectively. They completed a strategic refinancing.
What does that achieve?
Two key things. It reduced their average cost of debt from 9.1% down to 8.4%. And perhaps more importantly, it significantly extended the loan tenure from an average of 8 years out to nearly 15 years.
Longer tenure, lower cost.
Yeah.
That provides significant financial stability and predictability.
Absolutely. And it contributed to their credit rating being upgraded to AA, stable. So the financial foundation seems rock solid for executing their growth plans.
Which brings us back to that big target, that 20,000 million or 2,000 crore EBITDA goal by fiscal 30. How realistic is the path to get there?
Well, the strategy outline has multiple pillars. First, they're counting on continued strong growth from their existing hotels, same store growth. Second, there is the pipeline of new hotels coming online.
How big is that pipeline?
Over 1,500 keys are in development. This includes sites in really interesting high-growth locations like Agra, Ayodhya, Bantavgarh near the Tiger Reserve, and Srinagar. So a mix of leisure and pilgrimage destinations.
Diversifying beyond the big city business hotels.
Exactly. And third, of course, is the expected contribution from the new developments we've discussed, BKC in Mumbai, and the international foray into Dubai. It's the combination of these three that they believe will bridge the gap.
And we should probably quickly touch on sustainability, too. It's becoming a bigger factor in operations.
Yes, they highlighted progress there. In Q2, they commissioned a 2.25 megawatt solar power plant at the Leela Palace, Chennai.
Significant step.
It helps push the company towards having about 65% of its total energy needs met by renewable sources. It's part of their longer-term goal towards net zero emissions by 2050. Hashtag tag outro.
Okay, so if we try to synthesize all this, what really stands out is first, that clear operational outperformance domestically, that 3x rev payer growth, is hard to ignore. It gave them the credibility and the cash flow.
Right, and then building on that, this strategic agility and, frankly, creativity in how they're structuring growth.
You mean like the Dubai deal?
Exactly. That equity recycling model, aiming for a stake in a world-class asset for potentially zero net equity, that's thinking differently about capital.
And the BKC restructuring, too, doubling down on the high-yield hotel component and letting the partner handle the office space, it shows real focus.
The pattern seems clear. Use the Brookfield partnership to access prime real estate you couldn't get alone, like on the Palm Jumeirah. Then focus LPHRL's own capital and operational expertise purely on the luxury hotel part, where they excel and where the margins are highest.
Maximizing return on capital employed seems to be the mantra.
It really does. They're setting a high bar for how to grow smartly in this space.
So, thinking about that growth, they're pushing into international gateway cities like Dubai, but also into these domestic resort and pilgrimage markets like Ayodhya, Ranthambore, Srinagar. It raises a question for you, the listener, to think about.
Yeah.
How is this shift balancing their traditional, very successful city-based luxury hotels with this growing portfolio of resorts and international properties? How might that change the overall Leela brand identity and perhaps its profitability mix over the next, say, 3 years?
That's a really interesting point. How does the brand evolve as the footprint diversifies so rapidly? Definitely something to watch.
Indeed. Well, that's all the time we have for this deep dive. Thanks for tuning in.
Thanks for listening.